Hello everyone. You must have heard of inflation being spoken about by economists and everyone around you. While this may seem confusing in simple terms, inflation is the rate at which the general level of prices for goods and services is rising. It's the reason why a candy bar that used to cost 2 rupees might cost 5 rupees a few years later. Now you must be thinking, why is this inflation even happening? We all know that the prices of goods and services are ever increasing, and to be more clear, there are genuine reasons contributing to this. Consider the following scenario. A fruit vendor is selling his last lot of mangoes when he is approached by three people who are eager to purchase them. The merchant has now raised the prices of mangoes. The customer who can afford to buy it will, while the remainder will not. Now, did you observe that as the demand for mangoes climbed and the supply was less, the prices increased? This actually states the main reason for the price hikes, which is inflation strikes when the demand is high but the supply is less. Other factors like changes in import, export, and monetary policies of the government, temperature, or other geographical conditions can also cause inflation to creep in. The government of most of the countries measures the inflation rate with respect to CPI or Consumer Price Index, and India is one of them. The CPI tracks changes in the average prices of a basket of goods and services commonly purchased by household over time. This basket is a list of the goods and items that are selected based on the spending pattern, average household budget, geographical location, frequency of purchase, etc. This concept is somewhat similar to grouping or basketing the goods and services based on which the CPI will be calculated. The current base year which is considered for calculating the CPI in India is 2012. So, CPI is basically the cost of the basket of goods and services of a given year divided by the cost of the basket in the base year, which is 2012 year, multiplied by 100. CPI serves as an important indicator of inflation not just for the government but also businesses and even individuals to monitor price changes in an economy. So to get the rate of inflation through CPI, simply subtract the past CPI from the current one, divide the result by the past value of CPI and multiply with 100. When talking about inflation, banks are nowhere behind. Inflation and interest rates are inversely proportional. So people borrow more from the banks and save less when the interest rates are low. Saving less or simply spending more raises both the supply and demand for money in the economy. As a result, the commodity prices rises and cause inflation. But that was just about inflation in general. Now, what happens when the inflation is high? High inflation pulls down the value of currency. Each unit of currency is now worth less of any given goods or services. Let me explain it to you by this simple math. Let's say 500 ml of milk costs 20 rupees at the beginning of the year. However, due to inflation, the general price level increases by 5% over the year. This means that by the end of the year, the same packet of milk will cost 21 rupees. In this scenario, the value of the currency has decreased relative to the price of the milk. Initially, 20 rupees could buy 500 ml of milk, but after the 5% inflation, the same 20 rupees can only buy 475 ml of milk. In this example, we saw that 5% inflation gave us 475 ml of milk for rupees 20 instead of 500 ml. This means we are getting 25 ml lesser milk for the price we used to pay for 500 ml of milk. That is the same amount of money for less products and services, which explains the phrase, each unit of currency is now worth less of any given goods or services. There are undeniable negativities that can hover on the economics of a country due to the price hike. But luckily, there are also ways to balance the adverse impact, fostering a healthy economy in a country. Now, let's delve deeper into the different effects and understand the trade offs associated with inflation. When thinking about inflation, the first thing that comes to our mind is purchasing power. It is the quantity of goods and services that we can purchase with our money. Inflation reduces this purchasing power over time, lowering living standards by rising the cost of living. That is, for the same amount of money, we get to buy less and fewer commodities and services such as a loaf of bread or a doctor's appointment, but our income remains largely stagnant. However, this is countered by the anticipating attitude of many customers who tend to buy more during inflation, hoping not to spend any more money on the same things in the future. Another thing that must be mentioned in this case is the creation of new jobs during the period of inflation, which also helps to balance the economy. Let me explain this with a flowchart. When the demand for goods and services is high, more jobs are created to meet the supply lag. This increases the number of workers and the nominal wage, and the workers spend that amount for livelihood. This increases the purchasing power, which further contributes to economic growth. Higher inflation can impact exports by directly impacting input costs such as materials and labor. As a result, inflation slows down trade through exports. However, we have imports that cancel out this effect. When domestic costs rise, imports become more appealing since they are less expensive. A Chinese phone at rupees 10,000 will sell more than a homegrown phone with the same functionality but a higher price. Thus, imports compensate for the economic loss caused by the exports. Now, what about investments? Price hike hugely hampers long-term investment planning by trembling investment decisions, leading to instability in markets and businesses. Luckily, the same anticipatory behavior fosters investment and entrepreneurship here as well. People are more likely to invest their money or create new firms. They even force ordinary people like us to invest in stock markets and mutual funds. This increased investment and entrepreneurial activity promotes economic growth, job creations, and innovations. But what is the lender borrower seen during inflation? Lenders are generally at loss. When inflation is higher than expected, the borrowers pay back their debts in less valuable currency. The lenders suffer while the borrowers are at profit as it eases up the financial strain on them and their businesses. This may also give rise to the scenario of what we call redistribution of wealth. And here's another point. What do the central banks like Reserve Bank of India do during inflation? They use it as a tool to manage economic growth. By controlling the money supply, they try to maintain what's known as target inflation, which is 4% and currently at 6.8% for the financial year 2022 to 2023, with 4% being the long-term target. This indicates that the RBI recognizes the need for some level of inflation to support economic growth but keeping a check on it at the same time. So, if we see, moderate inflation can stimulate economic growth, encourage investment and entrepreneurship while minimizing negative effects on purchasing power, uncertainty, wealth redistribution, and market distortions. But too much of it can directly impact the economic health of a country. Understanding the trade-offs associated with inflation allows policymakers and individuals to make informed decisions to maintain a stable and thriving economy. By carefully managing inflation, societies can harness its positive effects while mitigating its negative consequences. which can pave the way for a sustainable economic growth. That's all. See you again in another video.